Guys, Nathan Robert here. I want to share with you a stock that I have been buying like crazy, and it's actually my largest holding in here. Check out this company right here. You've probably never heard of this company. It's ticker symbol CSL. Their name is Carlisle. And again, you've probably never heard of them, but that's what I love. I want to introduce you to a new company you've probably never heard of before, and I want to introduce you to how amazing this company's financials are and the amount of growth that they're going to have in the future. So check this out. Literally just in the past month, they're down 18%. So now is kind of like a good time if you want to get exposure to the stock. Now's a decent time to dollar cost average into them. They've been a great performer over the long run. Like they've outperformed the S&P 500. They're up 131% the past 5 years. And let me show you my history real quick. I just bought one share of them before this recording at $375 and also one on December 23rd for $373. And we can see our dividend history as well. They pay $1 per share, but I'm about to show you their financials. They literally have room to 3x their dividend right now, but literally they just choose not to. So yeah, this company right here is worth $4,500, all my shares combined, and that's actually our largest holding between all our portfolios. Our largest holding in here is Powell Industries, worth $2,700. But let me quickly show you why this company is just so fantastic. So they do pay a dividend. They're a $17 billion company, and look at their valuation right now. They're trading at 13 times trailing 12 months EPS, and the forward PE ratio is a 20. The trailing 12 months PE ratio is a little bit artificially suppressed right now because they just sold off one segment of their business and got a bunch of, close to $2 billion for that. So it hit their EPS. But anyway, here's their net income when you don't include that one-time gain on their money. So look at this. They made $246 million of net income in the most recent quarter. So remember that $246 million just in the most recent quarter, and their dividend only cost $45 million. And, that's a very low payout ratio. They have room to just in one quarter, they could pay for the entire year of dividends. And look at their dividend history right here. This company is actually less than 2 years away from being a dividend king. So you heard me right. Yeah, they have over 48 years right now of dividend growth. And as soon as they hit 50, they will officially be a dividend king. And I also have a prediction that this company will be in the S&P 500. Right now, this company is not in the S&P 500, but I predict soon that they will be. So anyway, let's go back to their numbers right here. Remember how I said they sold off a segment of their business for $2 billion? Well, look at their cash on hand. You can kind of see that that's really true. Look, they have a bunch of inflow of cash. In the most recent quarter, they still have $1.5 billion of cash with clear and free inventory of $462 million of clear and free inventory. So I sometimes like to add that to the cash. And look at their diluted weighted average shares. This is nuts. They are literally... You love this one for the dividend growth and also the share buybacks. You won't believe this. You now own 7.2% more of the company than you did 1 year ago. So you have an 8% total shareholder return when you include the share buybacks and the dividends. And let me show you how much they're spending on share buybacks. So look at this. Just in the two most recent quarters, they spent nearly $1 billion on share buybacks. And remember, the whole company's market cap is $17 billion. So yeah, that's what I meant. It's very meaningful when they do these share buybacks. It makes their EPS go up. Look at that. They've always been a very shareholder-friendly company. They're always buying back stock. And look at their total debt right here. Total long-term debt is $1.89 billion. So literally $1.89 billion of total long-term debt. And remember, their cash on hand was $1.53 billion. And because they just got this huge inflow of cash, they're starting to make a bunch of interest on their cash. So they used to pay money and interest every quarter of debt. They have debt of $1.9 billion. They pay interest on it. Well, look at this. Now, since they have so much cash, they're actually making more interest than they're paying in interest. They made $4 million in pure interest. So that's what's great about this company. They also just acquired a company. Let me go to the news tab right here. Check this out. This was just a couple days ago. They acquired Thermofoam. This company is in the insulation industry and roofing. They mainly do roofing, and I cannot wait to show you this company's investor presentation. So we'll look at Carlisle's investor presentation right after I show you another stock that is in a very similar industry, and this is Toll Brothers right here. They're only a $13 billion company, but they're literally trading at 9 times net income. This is ridiculous. And look at the trailing 12 months EPS. They've made $15 trailing 12 months of EPS, and their annual dividend costs less than $1. It only costs 92 cents. So they have a 0.72% dividend yield. What I'm trying to say is they have room to 3 to 4x their dividend right now, no problem. They could literally 3x their dividend, but they just choose not to. Instead, they're doing share buybacks. So look at them in the most recent quarter. They made $475 million. So let's just say $400 million on average they make a quarter. So they make $400 million, and look at how much their dividend costs. You won't believe this. Literally $23 million. So that is a ridiculously low payout ratio. And if we also go to their stock buybacks, they spend way more, like 5 times more on stock buybacks than they're doing in dividends. So let me show you their total common shares outstanding. You now own 3.9% more of the company than you did from 1 year ago, but they're always buying back stock. Look at this every single year. Sometimes they buy back 10% of the company. This is ridiculous. So they're a very profitable company, share buyback machine. And how much cash do they have? $1.3 billion of cash on hand and a $9.7 billion of inventory. And how much debt do they have? Total debt of, oh, here it is. $2.8 billion. So this is a very financially stable, financially healthy company. They're not making it really any interest on their cash, but that's all right. They could stockpile up their cash, but instead they choose to, have that cash work for them. They buy back their stock, they pay out dividends. So that's Toll Brothers. This is another great one you can add to your watch list. This is a home builder. Since they're a home builder, they usually trade at these low PE ratios, like literally 9 times net income, and that's usually normal for them. But as they buy back more stock, Anyway, this is a great company. I want to go back to Carlisle, though. I want to show you a few slides from their investor presentation. And if this company does not impress you, feel free to hit the dislike button. Let me know any problems, or let me know anything wrong you can find out about this company. Let me know in the comments, but let me show you a quick slide from their investor presentation. You are going to love this. All right, so here's their most recent investor presentation. I'm going to get straight to it because this company is super impressive. So right now, they have 5,100 team members, but look at their adjusted EPS. It's 15.52 in the trailing 12 months. And remember, they have a $4 annual dividend, so a super safe payout ratio, and they have a 20% free cash flow margin. So if you go spend $100 with this company, $20 of that is pure free cash flow for the company. And here's what most of their revenue comes from: construction materials like roofing materials and their weatherproofing technologies. And most of this revenue is from the commercial industry, only 20% from the residential. So that's probably why you've never heard of this company, or you probably won't use their products. They own a brand called Henry Roofing. They have like sealants and stuff you can buy. But anyway, look at all their competitors versus Carlisle. Check this out. Out of all their 35 competitors of building product like commercial public companies, only 20 of them have $2 billion plus of revenue. Only 5 of them have a free cash flow margin of 15% or more, and Carlisle has a 20%. And only one of them has a return on invested capital of over 25%, and that's Carlisle at 26. So what I really believe in this company. They actually have over a 5% market share for the whole entire industry, which is pretty good. They're only a $17 billion company. But anyway, let's keep looking here. So here's their 2 different businesses. They have Carlisle Construction Materials, CCM, and CWT. These are the only 2 segments of their business. And here's, this is $3.3 billion. This is $1.3 billion. But look at this adjusted EBITDA margin. 30% EBITDA margin. Again, 92% of this is commercial. And then here's their CWT weatherproofing technologies, which owns Henry. It's 50-50 commercial and residential. And they have a 21.4% EBITDA margin. So both very healthy, great margins. And here's kind of all that they do. They do HVAC sealants. They do roofing membranes. Literally everything you see here. It all revolves around weatherproofing your roof and mainly your whole building here. They even have like foundation weatherproofing, EPS insulation. Anyway, here's another great slide. Look at this. They have highly resilient adjusted EBITDA margins over time. So look at here during 2020 and 2021, 21% EBITDA margin, 23%. And here, it slowly expands over time. But here's 2008. It was still positive, 12%, 16%. So this is a profitable company. And here it is now, 2024 to date so far. It's a 29%, the highest adjusted EBITDA margin since. So they're expanding their EBITDA margins. Yeah, look at this right here. This is the 3rd quarter highlight, 27% adjusted EBITDA margin and $5.78 of adjusted EPS just in the most recent quarter. And if you annualize this quarter right here, that's about $24, $25 of adjusted EPS. And remember, their annual dividend is $4. It's $1 per quarter. So again, super safe dividend payout. Look at this. They increased their dividend by 18%, marking the 48th consecutive annual dividend increase. So this company is super close to a dividend king. And same time this quarter, they returned $512 million to shareholders through dividends and share buybacks. Most of that through share buybacks, their dividend only cost $45 million of this. And they also just acquired another company. We just looked on Webull on the news tab that they acquired another new company 3 days ago. Well, this is from a couple months ago. They acquired a company called PlastiFab, which is pretty cool. Yeah, so here's their 2024 acquisitions. So when they report their next quarter for the whole annual year, they'll have one more acquisition in here, that Texas, I forget what they're called, but I just showed them a minute ago. But anyway, here are the two companies that they just acquired. So remember, they sold off a segment of their business for $2 billion, and now they're acquiring more companies. So that's what I love. They're spending money to grow the future of the company. This is what I love. And look at this. These are there's synergies in these acquisitions. Look at this. Expected cost synergies of $14 million and be 30 cents accretive to adjusted EPS in 2025. So because they just bought this company, that just instantly adds 30 cents to their adjusted EPS in 2025, which is great. So that's what I love about this company. Here's kind of their full year outlook, holding strong their free cash flow plus margin, assuming all this stuff right here. Great company. But here's the main part is their Vision 2030, which is, call it exactly 5 years away. So in exactly 5 years from now, the stock price right now is $470, $475. You should double your money by the year 2030 because they expect to have $40 plus of adjusted EPS to grow at a mid-teen CAGR. And if you just do a 20 times multiple on that, a healthy 20x multiple, that is a simple math of $800 stock price. So nothing crazy. You're not going to double your money in 2 years, but I think that's a very fair. Double your money in 5 years. Again, not financial advice, but this is just what the company has for their Vision 2030. How do they do that? Free cash flow to sales. They're crazy margins. They can just invest in the future. And remember, they just bought back 7% of the company just this past year. So they're going to do it through share buybacks and M&A. And I'll show you that right here. They say how they're going to do it. But oh yeah, look at this. So there's a lot of pent-up demand in the re-roofing cycle. So look at this. Re-roofing is historically recession resilient and poised to see tailwinds from the 2000s build. So look at all this buildup that happened from 1998 to 2008. All these, the average lifespan of a roof is like 20 years or whatever. We're in prime age for all those roofs to have to be, rebuilt. And there's they have to be LEED certified as well. And I'll get into that in a quick second here. And bear with me here. I really appreciate it. We're almost done with the presentation here. But here, the investors are actually mad at them. Look at their R&D. Their R&D spend, it's less than 1% of their top line sales today. They're saying they're going to increase their sales. They're increasing their R&D spend to 3%. They're going to 3x their R&D spend. And look at this. New products as percent of revenue is 25%. So they expect, like they just did, acquire all these new companies. And that's expected to make up 25% of the revenue for 2030. Today, it's only 15%, which is pretty cool. Oh yeah, so look at this. 70% of building products revenue were from LEED qualified product sales in 2023. So the US is actually forcing, if you want to repair your roof now, you have to have a LEED certified materials. You can't just build it with anything, is what I'm pretty sure is what they're saying here. So yeah, here's how the company expects to get $40 of adjusted EPS. Their free cash flow margin, their free cash flow to sales of 15%, allows them to reinvest, do acquisitions, dividends, and share repurchases. So this is just such a shareholder-friendly company. I think they even deserve a bit of a higher PE ratio because they're actually growing. If they expect to actually go from today, today is about $20 of adjusted EPS. They expect to double this to 40 in 5 years. So if they're growing at a mid-teen CAGR, I really like this company. That's why they're my largest holding, my literal largest holding. I'm not selling them, not financial advice. I hope you found some value out of this video in either Carlyle or Toll Brothers. I like both of these companies. I've been seriously considering a position in the Toll Brothers because I like them too. But for now, I'm sticking with Carlyle. I just bought 2 shares in them in the past week. Great company. Again, if they just pay out, McDonald's has a 50% payout ratio. I guess in the future, if you expect them to pay out 50% of their revenue, that would be $20 of annual dividends per share. And today it's $4 of annual dividends. So they have so much room to raise their dividends, share buybacks. I think the stock price is going to do amazing. That's why a lot of people probably won't like this company. They have a very low yield, but that's the kind of companies I want and look for. The ones with low yield but low payout ratios. And since they have a low payout ratio, they can acquire all these companies and do share buybacks. And anyway, hope you guys like this video. Again, my name is Nathan Robert. If you like this video, make sure to hit the like button and subscribe if you're new. Let me know in the comments if you subscribe. I'll leave you a nice reply. But I hope you guys have a great rest of your day.